let me jump to Dan here. So Dan, we have about 30% of our fund is in real estate loans. Talk about how it affected us, our investors, and what we did as an investor from that perspective.
The first thing we did is stop buying loans. And we did that across the three sectors of our portfolios. It wasn't exclusively directed at Allen or Sharestates. So we held back cash and we waited to see what was going to come over the horizon. We paid down our leverage line. We did fund some PPP loans, let us take U.S. government risk at a good price. So that helped us, certainly. But in the real estate segment of the portfolio in particular, we did see the effect of frozen projects and we did see some delinquencies. And our approach to valuation in our portfolio is to immediately recognize delinquency and take a negative provision against a possible loss or heightened probability of a default. And that really hurt us in April. We paid a distribution in April, but only just by the skin of our teeth, basically. What we've seen since then is the effect of the servicing that Alan's talking about. We've seen continuous dialogue with our borrowers. We see a continuous dialogue with Sharestates that gives us frequent updates on what's happening with loans. We're seeing projects come back online. We've seen loans get made up in terms of bringing interest rates back current. And we did fund some construction draws during that period as well. Just a small number, but we wanted to make sure that our borrowers could continue with their business and keep good projects good and not cause additional stress to them by reducing their liquidity. And now what we've seen in the last couple months is projects coming back online, loans coming back to current. We've seen some refinancing. We've seen some extension. So there's still current loans in our books, but they last a little bit longer than they did. But all of that's had a beneficial effect on the return on our fund.
Let's talk a little about, and Alan, if you can shed some light on what the lenders like Sharestates done to assist in servicing with borrowers, the role of government support to the borrowers. How has that helped the portfolio through this time?
Maybe I'll start with what we did first. What we did was pretty quickly implement what we were calling the forbearance application process. So we very quickly put together a PDF application that asked some basic questions, again, designed to prevent people being opportunistic. We were in an environment where every news channel was basically saying, don't pay your mortgage. And a lot of that was directed at consumer mortgages. It wasn't directed at business purpose mortgages, but they don't really distinguish between the two. And a lot of these borrowers are not sophisticated in that sense, right? They're not really looking at the difference between a consumer mortgage and a business purpose mortgage. That's really more the investment world. We realized right off the bat there was going to be opportunistic people that came through that wanted to take a forbearance because they felt they could. So we implemented an application, asked some basic information, and basically a process for collecting bank statements and other documentation to prove out the hardship that the borrower was claiming to have. And in many cases, we didn't feel that it was warranted. And the reason was these bridge assets were not term loan assets that were reliant on making their mortgage payments from debt service. So it's not like there were tenants in there that had to pay in order for them to pay their mortgage. These were construction loans where the borrower went in having reserved the cash or should have reserved the cash to make those payments. So we were really just looking to uncover that. In the few instances where we did find borrowers that were actually experiencing some stress, some hardship, we did a number of different things. In some instances, we did full-blown forbearance where we said, okay, you don't have to make payments for 3 months, 4 months. Not that we're going to forgive those payments. You're still responsible for them, but they'll be tacked onto the back end of the loan to pay off. In some instances, we did partial payments where you were making 25 to 50% of your payment every month, and the balance was getting pushed back to the payoff. I don't think in the end of it, I don't think we actually did any forgiveness of any accrued interest. I think in pretty much every instance where we granted a forbearance, we've at this point either been made whole or the loan is performing under the forbearance agreement. Then at some point in the future, when we have the payoff, we'll collect that otherwise was deferred. We did some amount of education on federal programs as well. So to the extent that borrowers were coming to us stressing hardship, saying that they have tenants that aren't paying in other properties and they were counting on the cash flow of those assets to pay their debt service on their bridge assets. We pointed to some of the government programs. There were essentially 2 core programs that borrowers could rely on. One was the PPP loan, and the other was the SBA loan, which was the IDL loan. In many cases, we were pushing our borrowers that were coming to us, telling us that they were experiencing rental income collection issues the IDL program, which allowed borrowers to go in and collect up to $250,000, and then it later was dropped to a maximum of $150,000. As long as you could demonstrate a material decrease in your rental collections, you could qualify for this loan that was interest-free for 12 months. And assuming you went beyond 12 months, it basically converted into a 30-year product.
That's in lieu of collecting rents from their tenants.
Correct. Yes.
Okay.
So it was a bridge, essentially. And then the PPP loans, those could be substantially larger. Those were primarily intended to cover payroll. And I believe up to 25% of the PPP loan was permitted for mortgage payments to the extent that you own real estate. Some of our borrowers did take those. We actually, as a platform, as Sharestates, took a PPP loan as well, given that originations were slowing down. Thought it was a smart move, and thankfully it was the right move for us. But that's really it. I think we had a very small portion of borrowers that ultimately did not qualify for forbearance with us, did not receive some other form of government aid, and ultimately actually truly defaulted. So there were definitely a lot of those opportunistic applications in there that we weeded out. And after we were done weeding them out, they just went ahead and paid as if nothing ever happened. So we maybe had like a 3 or 4% true pickup in delinquency rate from borrowers that couldn't make their payments.